Welcome to Insights for Outcomes. I'm Julia Newbould, Managing Editor at Conexus Financial, owner of Investment Magazine. Today it's my pleasure to be talking about navigating the disruption in energy markets. I'm joined by David Winans, who is a principal and credit analyst for PGIM Fixed Income's US investment grade credit research team. Specifically, David covers the US and non-US energy sectors for PGIM and is an energy sector specialist, having covered the sector since 2003. This year has probably been more affected by disruption than anyone had anticipated, and we're not sure where this will end. So I'm sure you will all agree that it's a fascinating time to be looking at the energy sector, and I'm thrilled to be joined by David today. Welcome, David. How are things for you right now?
Thank you so much. It's great to be here. Hopefully I can visit Australia someday.
We hope so.
Yeah.
So, David, we've got a lot of things converging to create the complexity we're seeing in the global energy markets. Oil markets recovering from COVID-related meltdown, the impacts of Russia's invasion of Ukraine on the global energy industry, and the longer-term focus of the energy transition. So let's look at them piece by piece, and both sides also of the demand and supply puzzle. Firstly, with regards to COVID and the supply side of the equation, can you please talk us through the impact on energy markets over the past couple of years and how you see that playing out, regardless of where we are with the geopolitical impacts of Russia and Ukraine?
Okay. Well, I mean, we kind of got to step back and take a little bit of a history lesson here. All right. So, everyone should kind of realize, what happened here in the United States, starting, I guess, maybe about 2006 and then onward for the next decade, the so-called shale revolution, where, U.S. oil production just basically, skyrocketed, went hockey sticking to the right. Okay. That went on for, good, 8 to 10 years. And during that period of time, the energy industry in the United States was aces. They were awesome at finding and producing, oil out of these tight shale formations. Companies like EOG and what used to be XTO Energy, Devon Energy, a lot of these independents. I mean, getting oil was not a problem. But during that whole period of time when I covered the industry, most of these companies, they didn't print a lot of free cash flow. There wasn't a lot of great returns. All right. So it was kind of explained to me, like, the investment thesis for that period of time. I had one company management team tell me, I'm like, you ask them, like, where's the cash returns here? Where's the payback for the shareholders? And it was explained to me, we're following a commodity plus model. That's the investment thesis. And what that meant was, rather than go out and buy a barrel of oil, just speculate on one barrel of oil, if I bought an upstream E&P company, if I bought this company, I could get the oil they had plus the prospect that they could produce more oil. So I get next year 1.25 barrels of oil, 1.5 barrels of oil. Okay. So it was a commodity plus type investment thesis. Okay. The problem with that was these companies are all trying to grow at, 8, 10, 15% oil production growth. They're all trying to generate all this growth. At the same time, oil demand globally was growing, but it's going like 2 or 3% a year. So it was inevitable that you end up in a situation where you get into some kind of oversupply. All right. And, that's what happened back in, at the end of 2014. Finally, you got into kind of a glut situation where there's, the shale guys just basically drilled themselves, they just at any kind of rally in the price, they just drilled into it. And returns for the sector, if you were an investor in the sector during that period of time, the returns were not good. Okay. So fast forward now, you get into about, 2016, 2017, 2018. Investors in the United States, they were frustrated. Returns hadn't been there. If I'd have went out and bought, a tech stock, I'd have done way better, right? Way better than buying one of these oil companies. All right. So they finally started to get the joke that commodity plus, especially in a world where you think that, oil demand is going to be less in 20 years or 10 years. Why do I need to keep growing production at, double digits. Okay. They finally got the joke that, hey, we need to focus on cash returns to investors. We need to focus on metrics where we can comp and, show people the money, like every other company in the Standard & Poor's 500. Okay. So they became much more disciplined. And you didn't see, like in 2018, 2019, companies weren't going out anymore, putting out like, hey, we're going to grow 15%. The new mantra was, okay, we're going to grow 0 to 5%. We're not emphasizing growth. It's all going to be, any dollar we get, it's going to go to the balance sheet. It's going to go to shareholders. We're going to be disciplined. So what you saw in 2019 is the market before COVID even hit, the oil market gradually started to tighten up. Okay. Things were kind of starting to get tight. Oil Brent was higher than $60 a barrel all through 2019. Okay. And, by December 2019, things were starting to feel pretty good in the oil patch. Companies were being disciplined. The returns were starting to come through. You were starting to see free cash flow. I put $60 into my model. Hey, this looks okay. Maybe we're finally starting to get somewhere. Then COVID hit, and everything just gets completely whammied. Now these companies that are already being disciplined, they went out negative $23 a barrel WTI. I said at the time this was like oil passing a kidney stone. All right, it was obviously a temporary thing. It was negative 20. It was negative. At Cushing, Oklahoma, because of financial. That was a financial anomaly. But still, that's scared the crap out of a lot of its management teams, right? That's really scary. So what did they do? They went out and they cut CapEx to the bone, right? Anything they could cut, any rig they could drop, they just cut it. And these shale wells, if I don't keep drilling, they decline, some of them 80% in a year, just roughly. Okay. So what happened was U.S. oil production went from, almost 13 million barrels a day to like 11 million barrels a day, like a 2 million barrel a day hit. Okay. In a matter of, 2 or 3 months, right? It just collapsed. Okay. So, and then at the same time, you had the OPEC crowd. They came in and they had their little price war, I think, that lasted about 3 weeks. And then they came in and made an agreement and decided they were going to, take oodles of barrels of oil off the market. So you had a market that been going into 2019. It was already starting to feel a little tight. COVID comes and boom, everybody just stops. All right. Then let's layer on the whole ESG situation. You had guys like the head of the IEA, chief. He famously came out and said that funding dirty energy was going to be a loser. And anybody who funded energy, you risk losing all your investment, right? You had the BP, their 2020 outlook. They assumed that oil demand had finally hit a ceiling, that we'd finally reached peak oil demand. Not 5 years from now, not 10 years from now, but immediately, okay? All of these pressures and, they're going into, the COP meetings up in Scotland and such. There was a lot of pressure from equity investors too, not just to show me the returns anymore, but, just don't invest any more dollars into this entirely. Okay. So, like I said, you had a market going into COVID that was already starting to feel tight. Okay. Everybody drops rigs because the price collapsed. OPEC becomes, they put in quotas. You layer on the ESG, all the pressure from investors to show returns. Now, COVID demand comes back, almost completely back to what it was. And now, lo and behold, we're in a market that's desperately, very, 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 very short energy. So you put yourself on a diet of capital in 2019, even before COVID started, okay? And then you starved yourself for 2 years. And you wake up in 2022 and it's like, hey, it's time to eat some oil. It's time to eat some gas. Nobody's cooked it. It's just not on your plate. So then, February of this year, the Ukraine, the Russian invasion exacerbates it even more. So that is really how we ended up in the situation. It didn't happen. It wasn't one single, oh my gosh, it was the OPEC cuts, or oh my gosh, it was ESG, or oh my gosh, it was Russia. And there's all these things, coming together. And you've created a situation where the market is just really short energy. And if it wasn't for, lockdowns in China, you probably have oil $20 a barrel higher right now, at least. So that's a long, long history lesson, but
No,
that's how we got here. That's what's happened.
So, David, can you tell us a little bit more about, where you just ended talking about the Ukraine invasion and Russia? How did the European situation affect everything?
Well, the European situation, you've got a gas crunch, obviously, that's going on in Europe right now. They're supposedly their storage is back up to 2021 type of level. But I mean, if you go into winter and you lose the flows, how many days of cover is that storage really going to last you? Where is the storage at is a big question. So you've seen gas prices spiral up to, 60, 70, $80 an M in Europe. And unlike, 10 years ago, where Europe was one gas market and the United States was another gas market, now you've got, roughly 12%, maybe 13% of U.S. gas production. It's going to Europe in the form of LNG. So it's pulling U.S. gas prices higher too. And there's a limit. Okay, this producer discipline in the United States is partially limiting the U.S. supply response to push gas and prices here in the United States. That being said, even if the United States could, put out another 10 BCF a day in gas tomorrow, you couldn't get it to Europe because the LNG facilities are bottlenecked. I mean, there's no more liquefaction capacity in the United States until Exxon's Golden Pass comes on in I think 2024. Just not getting any more. You're not going to get any more gas, but you could lower the gas prices here in the United States. But like I said, producers are being disciplined. And then second of all, building new infrastructure here in the United States. The pipelines has been a major challenge. There's a pipeline, I think it's $6.6 billion is the price tag on this pipeline right now, the Mountain Valley Pipeline. Okay. It's been hung up for years. I think they've got, less than 20 miles left to complete on the thing. And they've been waiting on that for, 3 years now? It's been a long time. And it's just been hung up in the courts. I mean, you've got the biggest 200 miles to the west of me. It's the second largest gas field in the world. And you can't get the gas out, right? It doesn't make any sense. So, I mean, there's solutions for Europe's gas issues, but they're years away and they require investment now. So, and then the oil situation in Europe, I have to say I'm surprised how well they've been able to redirect oil flows to keep the oil situation from spiraling out of control. But I have talked to a lot of people in the industry, both services companies and oil majors. I don't want to name drop, but a lot of people are worried that, Russia longer term, it could be Venezuela 2.0, where, these guys have pulled out. They've lost a lot of technical expertise. Can they really keep production up going forward? What happens when that part that they need breaks and they just can't order it from Houston anymore? I'm not sure Russia's productive capacity is going to be the same a year or two from now.
Yeah, very interesting.
So it's a mess. I never thought I'd see a mess like this, but it's a mess.
So, David, what do you see as the geopolitical and energy policy alternatives for different countries, and for Europe in particular?
In the near term, there's no physical solution in the near term. In the near term, there has to be some kind of political solution because there's just not going to be the amount of gas they need this winter. If Russia cuts off flows, all right, and I think it's anybody's guess if they will or not. But the Europeans and the Americans too. I mean, you're seeing the beginnings of them trying to explore alternatives to a solution. There's one major I talked to last week, and their CEO was in Egypt thinking about more ways to get LNG. The Germans and the Canadians, the Canadian Prime Minister Trudeau promised last week he would get more LNG to Germany. He'd supply Germany with LNG, which is very interesting considering there's no LNG export facilities in Canada. That being said, there's plenty of gas in Canada. Now, there were some technical problems with this, but the gas price in Alberta, natural gas price in Alberta, a couple of weeks ago was almost zero. Okay. So there's gas in Alberta. Now, some of that was mechanical and such, but even today, I think the price is like $2.50. Okay. There's gas in Canada. But once again, can you get it to the place you need it to be? This should have been done like years ago, but these politicians are talking now for the first time in a long time, like, maybe something needs to happen here.
So when you're talking about, LNG as an alternative energy source, the challenges mainly are the actual getting it to where it needs to be. Is that what?
Yeah, you have to liquefy it. And these facilities, they take, at least 2 years to build, and they're billions of dollars. And it's not going to, it's too late to do anything about it by, this winter. It's not going to make a difference, but something's, you need to start putting these in. I mean, as an alternative to LNG, I mean, there's imports from Africa too. There's pipelines, that flow into Italy and such from Africa. Those pipelines, my understanding is they're not full. So if you invested in some of these African countries too, maybe that could be an alternative. So, I mean, but once again, these are long-term solutions, and the crisis is now. So I don't know what the answer is going to be, but there's going to have to be a political solution to this. And you can't come and tell me it's like, okay, we're going to do renewables, right? Because renewables, they're not going to. Here's the thing with renewables: 60% of the time they work every time. All right. So, and renewables are not going to satisfy like things like aviation demand, trucking, shipping, industrial uses. They're not that great for heating your home. They have their place, but that's not the investing in renewables. That's not going to get you through the winter now. At this point, it's too late for that. I mean, the grid level storage, it's not ready for prime time. So,
when we talk about the higher prices, what's been the response of US oil and gas producers to higher prices? Is producer discipline likely to continue in the way?
See, it is likely to continue for the independents because you can't get the crews, you can't get the equipment. All right, that's part of the issue. And the Permian Basin, I mean, cost inflation is already a concern. How many more people and frac spreads and rigs can I shove into the Permian? And if I start to move, assets to other plays like Oklahoma or the Bakken, like I said, can I get the crews? It's going to cost, right? And these companies, like I said, they were beat up for over a decade saying, okay, every time we got a price rally, you guys drilled into it. Why do they want to go out and subject themselves to 20% inflation on a well when their investors are going to freak? Okay. And then on the only guys who are really ramping up production in the United States are privates who probably, they have a different, set of considerations. And you have seen Exxon and Chevron ramping up as well too, but I think some of that was already kind of pre-planned. They already had some of these wells drilled and ready to go. But it's going to be tough to really get back to you could probably you could get back to 13 million barrels a day. I mean, you get back to pre-COVID level of production, but to get past that, it's not going to be, it's not going to be like, 2008 to 2014 where the U.S. was adding, 1 million barrels a day every year like clockwork,
Oh, when we go to investors, what role do they play here in the energy transition? Is there a friction between making returns and being good global citizens here?
No, we're bond holders here at Prudential, so I don't get a vote. Okay. So it's not my place when I meet with management teams to go and tell them like, you need to be a better citizen and such. I just want them to, pay me back my principal primarily. Okay. But it's an interesting question because in the short term, you have a fiduciary duty, to go out and chase, to get returns for your clients. We had one client ask us to sell what was my top pick, top bond pick for ESG concerns. And that bond performed very well. So how do you justify that as a fiduciary to your investors when the price signal is saying, gee, I can make a lot of money here, but on the other hand, I've got, am I contributing to global warming if I give these people capital? Well, you're contributing to, people freezing if you don't give them capital, maybe. So it puts just speaking of me personally, the problem I have personally with ESG is it puts me in a situation to make these judgment calls, right? And, to me, making these value decisions should be the job of politicians, not securities analysts, right? So it's just, I don't know. It makes life a lot more difficult. That's for sure.
So, Dave, from your point of view, from a purely returns perspective, oil and gas still look like good investments?
In the short term, these guys are money good, and some of it is the move up in rates, but there are still oil and gas companies out there with bonds that are trading below par. Okay. Meanwhile, some of these guys could be net cash. If you're an equity investor, I know a gas company, I was looking at, even if you really discount U.S. gas prices next year, it's still trading at like 4 times cash flow. So, I mean, if you think these prices persist, or even if they come down some, I mean, you're making a lot of money.
Yeah.
So that makes good money.
To that longer term conversation and the movement behind the energy transition, with many institutional investors making net zero commitments and aligning portfolios with the Paris Agreement. So how does it look in the long term with regards to the energy transition?
I wish I knew what oil demand was going to be like 10 years from now. But, all I can say is, there's been a lot of pressure put on the supply side of the equation. Meanwhile, oil demand and gas demand, it hasn't moved at all. If anything, it continues to increase. And for every person in California who's buying a Tesla, God bless them, how many people in, Vietnam are buying their first car, right? I'm not convinced that we've seen the peak, in demand for these, for fossil fuels. And the energy transition, I'm going to say it's a little overhyped. It's a little overhyped. I I wish I could say otherwise, but I don't see demand rolling over anytime soon.
So what is your view on the transition pathway and how investors should be considering this in the light of the shorter term potential returns in oil and gas?
In the short term, the money's there in oil and gas. A lot of these transitional technologies, hydrogen and such, I haven't seen any demonstrable economics out of them. So I feel if you're an investor and you want to get involved in the energy transition, do I want to invest my capital in someone, and at these prices, maybe I drill an oil well, I'm getting 40-50% return. Okay. If I put my money in a wind farm or a solar plant, I'm going to probably get a utility like return, 8 to 11%. Okay, maybe. If I invest in some of these more far out the road technologies like hydrogen or something, who knows what my return will be. So I think your risk tolerance, I think if you're an investor, if you really want to get on the cutting edge of this stuff, I think it's not for me as a fixed income person, my clients, God forbid. I think it's more, a venture capital or, private equity is more, suited to take some of these risks that are further out the stream of, the energy transition, right?
So David, for our investors that are listening to this conversation, what is your advice in terms of navigating both the short-term and long-term outlook for energy markets?
In the short term, it's really all a question of demand. Okay. You got the COVID lockdowns in China, and, there's worries about a recession here in the United States, although, U.S. oil inventories have continued to, draw very, very, really draw down this whole summer. Right. So I think, if you want to make money in the short term, it's a demand call. Now, the longer term, the supply side of the equation, it looks compelling. U.S. producer demand is in place. You've got big questions about the supply, the supplies coming from Russia. We've seen disruptions in the energy patch before from Iran, saw Venezuela, you saw, there's, Iraq, that there was wars there. You've seen, various disruptions, but, Russia is one of the big three. If you can, in oil and gas, the demand side of the equation is always the hard part. Now, the supply side, if I wanted to come up with my supply number, I would just add up all the guidance from the U.S. guys, and I knew I could pretty much count on that. In fact, I could probably build in a little bit because they'd always sandbag. Okay. Then the Saudis, you can believe what the Saudis are going to do. Saudi Aramco, you say what you will, but they're reliable. Okay. And you can generally count on Russia too. Okay. Give or take. So figuring out the supply was not the problem. It was figuring out the demand. Now I've got to look at the supply because Russia has become a big question mark. And that's one of the big three. And this isn't Libya or Venezuela. It's bigger than all of those countries. It's bigger than those put together. Okay. This is a huge issue. So if they lose 20-30% of their capacity, now you're really in a pinch. Okay. So, there needs, an oil price of $90 a barrel is telling you we need more supply investment now. Okay. But the funny thing is, the ESG considerations and such have got many companies, like maybe some of these European oil majors, saying, we don't want to make those investments anymore because we're under pressure. So we're going to go do, wind farms or artisanal coffee or solar farms or whatever, right? And take the 9 or 11% returns because that's what our investors want. They don't want the 40-50% returns from a new oil and gas project though the price is 90. So, that's a bit of a head scratcher. Okay. So there has to be some kind of a supply response at some point if you think the demand is going to be there. And like I said, despite this energy transition, I haven't seen any clear evidence that demand is really rolling over anywhere, aside from, European natural gas, which is going to definitely get some demand destruction pretty, but globally, it's still strong. People want this stuff, and it's hard. You can't replace all of it that easy. People equate oil as, okay, that's the gas that goes in my car. But it's so much more than that. So much more goes into petrochemical, aviation, shipping, trucking. It's even if you do electrify a lot of these cars, where do I get the copper? Where do I get they weigh more. They're 2,000 pounds heavier. Where do I get the cobalt? All right. The lithium. I mean, a lot of questions. And where do I get the electricity to generate this to begin with? So I think, the answers to this, longer term are very uncertain. I don't know the answers. But in the short term, I'm seeing like a lot of cheap paper out there, a lot of cheap paper. So I feel like, I feel like my number one job is to make money for my clients today. So, that's what I'm going to do.
Thank you, David, so much for the conversation today. It's been really interesting, and there is so much that we've got to learn.
Yeah, it was great talking to you.